Good afternoon, everyone, and welcome to the RealNext webinar series. I am Jeff Finn, CEO at RealNext, and delighted to be joined by Dr. Glenn Mueller today to talk about his real estate market monitor and market cycles in commercial real estate. I think it's an extremely appropriate time to be focused on the market cycle monitor, look at supply and demand in the industry, talk a little bit about the capital markets and the impact as well, but really finding the underpinnings of the industry. And even as we've had a spike in interest rates and a peak inflation mode, we're still seeing some interesting dynamics in the real estate markets across the country, growing and continuing to be strong, with each of the commercial sectors in a mode of expansion based on his findings. So Dr. Mueller is going to share with us his findings through the end of the second quarter, and then give us a little bit of a feel for perhaps some of the things that have changed subsequently that may be impacting where we're at today and where we're headed in the future. So we're very fortunate to have Dr. Mueller with us. He's internationally known for his work in market cycles, both in the public and private markets. He's professor of University of Denver's F.L. Burns School of Real Estate and Construction Management, teaching and researching real estate market cycles, development, feasibility, investments, and capital markets, as well as academic director for the Family Office Real Estate Institute, with a BSBA of Finance from University of Denver, MBA from Babson, and PhD in real estate from Georgia State. Certainly well qualified to be speaking with us today, and I know you're going to be very well served with his insight, and certainly open to questions along the way for him to add additional insight as we get through this session and his presentation. Take your questions and post them along the way or towards the end of the session. So with that, Glenn, I'll let you take it away, and look forward to hearing what you have to say.
Great, thanks very much. And just for a little bit of additional background, so at University of Denver, we're the second oldest school of real estate in the country. We've got an undergraduate degree, graduate MBA and MS in real estate, an executive Master of Science in Real Estate and Construction Management. And most recently, we actually started an executive PhD program. So you could, if you're really hot to get a terminal degree, you can get a PhD at DU now in real estate. You only have to come to campus 2 weeks a year. You take most of the classes online, and then work on a dissertation as you go along. Family Office Real Estate Institute may be new to many of you. It's actually only a little over a year old now, with three main things: education, research, and community development and interaction. And by family office, what I mean is the wealthy families that have made their money in something, that also invest in real estate. Probably the biggest example I can think of is Bill Gates. Many of you probably know he is the largest investor in farmland in the United States, and his family office has a unique name that you would never recognize, hence it doesn't connect that way. So if you have wealthy families who are looking to get together with other wealthy people, most of them don't want their name out there. So our list is totally private, because they're honestly worried about things like getting to having their kids kidnapped or that type of thing. So it is a unique opportunity for that. We do an annual survey, and on average, out of the 300 people that we survey every year, on average, 24% of their wealth is invested in real estate. So they should be good opportunity clients for you going forward. So I always like to start that every real estate investor, advisor, or watcher of what's going on in income producing real estate. Notice I use the term income producing versus commercial because I add apartments into it. Our three main things: number one, population growth. Today we're growing at 0.7%, which equals about 3 million people a year. That means we need to build a complete city size of Denver, Colorado, to give them a place to eat, sleep, shop, work, play, pray, and store stuff. So, and our population just continues to grow. So that's always good for demand for space. GDP growth, as you all know, we've just had 2 quarters of negative GDP growth, but the forecast going forward looks like it should be a little slower. We've been 2.4% over the last decade between the Great Recession and the COVID recession, and probably a little sub 2% here going forward. And by the way, this number, you'll almost never see a 10-year forecast. This actually comes from the Congressional Budget Office. They actually forecast out 10 years because they use that information as they model for the different legislation that they're putting in place. So kind of gives you an idea of what the government is thinking about. Their new model should actually be out shortly, and I'm sure it'll change a little bit from this. But as I think you all probably know, the number one thing driving demand for real estate is employment growth. And it was running right about 2% between the other 2 recessions, and going forward looks like averaging around 1%. You'll notice that it actually 5 years out from now looks like it drops off to sub 1%. And the reason for that is the simple math of more baby boomers like me in their 60s who are going to be retiring, and then millennials coming out of school, and that would be either high school or college, coming into the workforce. So that growth rate is, net inflow and net outflow, still positive, but just slower as more people retire. However, I'm sure many of you know, a lot of older people, as they retire, end up turning around after a while, they get bored and they come back into the workforce doing something. So we will see how that works going forward. On the cost side, obviously inflation, between the 2 recessions last time averaged just a little over 2%. The current forecast by the government's 2.9, and as you know, the Federal Reserve has always had this target rate of 2%, which means they're probably going to continue to raise rates here to try and bring that back down. But I'm not sure it's something they.
I'm sorry, your audio is breaking up a little bit. I don't know if you have a mic that you might be turning away from, but if you can just try to adjust it.
Actually, one of the things that happens sometimes is as I change slides, it breaks for a second. So after each slide, I'll take a little pause just to let that slide load up. Sorry about that. I'm in a different location today, so I don't have as high a speed a connection. Am I okay now?
Perfect, thank you. Yep.
Okay, great. Yep. So, Barry Sternlicht from Starwood just came out saying he thinks the government or the Federal Reserve should stop their increases because they're going to do more damage by continuing that increase. And of course, the world is in a very unique situation. We still have supply chain restrictions, hence that means that manufacturing and other things are also slower because of it. And so that supply restriction increased costs or inflation as we go along. Plus, the other thing that's kind of interesting is that the average savings rate in the U.S. has historically been around $1 trillion a year. During COVID, it went to $4 trillion, and supposedly that number today of people sitting on savings is $5 trillion. That doesn't mean putting in their savings or checking account. That's also investments in stocks and bonds, retirement, real estate, and other things. So to me, the world is really somewhat awash in cash, looking to go someplace and obviously looking for yield. And as interest rates go up, it does make fixed income bonds look a little more attractive than they have been for a long time. And speaking of that, let's look at the interest rates. It wasn't but a decade ago that the 10-year Treasury in 08 or 05 and 06 was running around 5%. Today we're not even quite to 4 here yet. It kind of bounced down and averaged right around the 2 to 2.5% range in between the 2 great recessions. Hit its absolute low ever in history in May of 2020 after COVID hit at 0.6%. And as you all know, it's been bouncing up very quickly. And I think that it will probably get pushed higher here shortly. And we'll actually talk about that a little bit more in the second part of the presentation here. So I'm going to let this sit for 5 seconds. What you can see here is historic cycles, if you will, of the economy. I've got both GDP and employment overlaid on each other. They obviously move very closely together. You can see that most economic expansion periods last somewhere between 5 and 10 years, and all recessions have historically been pretty short and slow. And in some cases, employment's gone negative while GDP has stayed positive. I think right now what we're seeing is, for the first time that I've ever seen it, we actually have employment being positive and GDP being negative. We've never seen that before. And so that is a unique situation that, some people say, well, we really didn't go into a recession because employment growth has been positive. The latest number for September just came out at 205,000 jobs, and it's been running in the 300,000 to 400,000 range every month during the past year. So while it's slowed down a little bit, it's not negative. And again, employment growth is the #1 driver for demand of income producing space. So back in 1990, I went to work at Prudential Real Estate Investors, and they asked me, we were in a recession then. They asked me to figure out what happened, why it happened, and if we could model it and do a better job of forecasting it to make better investment decisions and management decisions on the properties that they owned and advised for institutions. What I figured out was that there's really 2 parts to the real estate cycle. The physical cycle, which is demand and supply for space that drive occupancy levels, and that's just the inverse of vacancy. I like occupancy better from a verbal and a visual standpoint. It's much nicer to say things look good, occupancies are up, versus things look good and vacancies are down. Occupancy drives rent growth. And if I look at the income side of real estate, occupancies plus rents give me the total income growth for real estate. We'll talk about real estate prices in the second half and how it's capital flows that really affect those. So here is the cycle chart that I developed back in 1990, and been doing this now for the past 30 some years. You can see that the occupancy is just flip it upside down, and it's the vacancy chart. At the bottom, when you got too much of any product, what do? You drop the price. So negative rent growth at points 1, 2, and 3. Then it turns positive, but typically at a rate below inflation till we get to the long-term average occupancy at 0.6. And by the way, every market has a different long-term average occupancy rate. In contrast, if we look at New York City, its long-term average occupancy has been 91%, or a 9% vacancy rate. In a smaller, faster-growing market like Denver, Colorado, the average has been 87%, or a 13% vacancy rate. So in my modeling of each city's cycle, I actually look at its historic movements and calculate that long-term average, something that each of you can easily do with the data that you have. Once we get above that long-term average, 0.6, you see rents rising rapidly towards new construction levels, and 0.8 on that graph is what I call cost feasible new construction rents. And by that, what I mean is that if it costs $400 to build a new office building and investors want a 10% rate of return, you need 10% or $40 rents in the marketplace to cost justify building that new space. At that point, new construction really gets into full swing, and we typically don't supply what we need right away. So supply is lagging demand, so we get strong rental growth all the way till we get to peak equilibrium. And like in the last decade or so, 2% employment growth and 2% new construction means that we're growing them at the same rate, and hence we have equilibrium. After that, one of two things happens. Either we start oversupplying, which we did in the 1980s with office space and have done in other property types at different points in time, or we get the demand dropping off, mainly due to a recession. And now that supply is growing faster than demand, we go into the hyper supply phase, go back through the long-term average, and at points 15 and 16 get into negative rent growth. So a study that I published many years ago, you can see that at the bottom we got exactly what as expected, negative rental growth at the bottom, slow and positive rental growth all the way up to the long-term average, 0.6. At 0.6, that 4% was equal to the average rate of inflation between 1968 and 1997. Then very strong rent growth all the way up to a peak at 12.5% at 0.10. And then it starts to decelerate, not decline, but slow down, 11, 10, 6, back to a little bit below inflation at 0.14, and then low and negative in the recession phase. I just did up with that information and from 2000 to the end of 2001, lower negatives in rent growth at points 1 and 2, again positive and slow at 0.6, basically about the rate of inflation, 1.7%, and then you see it rising again. This time in the last 20 years, hitting its peak at the top at 0.11, and then slowing down and going into again lower rates as we get into the recession area. So every quarter I put out my market cycle report. Those are available to you on RealNex. And you can see that basically I consider every property type on a national average to be in the expansion phase of the cycle. Demand has been historically better than supply up through the end of second quarter of 2022. And we'll talk forecast here in a minute, okay? And again, I model each individual city based on its employment growth. And I'm sure most of you have heard of economic-based industries. They're an industry that exports a good or service outside of the local economy, brings money in, and causes that economy to grow. So easy example is Detroit, Michigan, auto industry based that drives the growth there. If the auto industry does well, Detroit does well. When it's not, Detroit doesn't do well, okay? For every economic base worker, there are 2 local workers that support those economic base industry workers. That's the person in the grocery store, at the gas station, the doctor, the lawyer, the attorney, the hairdresser, people that just service people, you know, that live locally. So monitoring the health and growth of your economic base employers in your city is a really key thing that you should be doing to help you as you consult with your clients. To do that, I've got a quick list here of the things to do. What you do is go to Bureau of Labor Statistics or BLS.gov and look at the quarterly commercial employment and wages. And here are the kind of the steps to go through to get that information. I'm going to show you what the output looks like here. And again, we use the NAICS, the National Employment Codes, North American Industrial Classification System, to get this information. By the way, employment data is extremely accurate. It comes out every month. And it's because every time someone is hired, they have to fill out a 10K or a W-2 form that gets sent into the government so that they can start collecting taxes. And that's why that number is accurate, basically, you know, and can be picked up every single month. So what we do is we look at the national employment percentage in each of the major employment categories, which you can see here on the left. And then we take the local percentage and divide it by the national. So if it's the same as the national, the location quotient would be 1.0. In other words, we have like 0.5% in oil and gas, and the national average is 0.5%. We're exactly equal to the national average. So here you can see I've highlighted and I'm going to do 3 different cities here as comparisons. You look at Boston, And in information systems, the quotient is 1.55, or 55% higher than the national average. Finance and insurance, companies like Fidelity are headquartered there. Professional and technical services, 1.77. I'll jump down to educational services. And by the way, this isn't K through 12. That's government employment. This is universities, and you see that that number is 2.3. Boston has one of the highest number of universities and colleges in its MSA in the entire country. And then health and social care. Normally, we don't see healthcare as a economic-based industry, except for 5 cities across the country that have major research hospitals. Boston with Harvard, the Mayo Clinic in Rochester, New York, the Anderson Clinic in Houston, the Cleveland Clinic, #1 in the world for heart and that type of thing. So let's take a look then at Chicago as an example, moving across the country here. Because it's dead center in the country, it's a seaport, as well as major railroads go through there, as well as it's a huge trucking industry as well. You see that wholesale trade is 26% higher than the national average. Transportation and warehousing is 30% higher than the national average. Finance and insurance is higher, mainly because the Chicago Board of Trade, all of the commodities trades happen in Chicago. And administrative and legal is basically when you have company headquarters are there as well. So all these cities have, if you will, a diverse group of economic-based industries that kind of drive their growth. If I then click over to Denver, what you see is mining, quarry, oil, and gas extraction at 1.5. And by the way, then the next number over is how those wages are doing. So the wages in mining and extraction are 118% higher in that industry than they are on the national average, even though the employment's only 50% higher. So we do have a number of headquarters there with higher paid employees. You see construction high, and normally construction is only for local, except in 2 cases. One, when you're overbuilding, and the other one is when you have a retirement or a resort area. So Florida, Arizona are the major cities there. Typically their numbers are higher because you're building second homes or retirement homes where people are coming and not working. And obviously in Colorado, we've got ski areas and everything else happening. Information finance, real estate's high because of the sale of second homes and that type of thing. And then interesting enough, arts, entertainment, and recreation, well, that would fall to ski areas and that kind of thing. So knowing the major industries that are driving your local economics, really important for you in helping. And then obviously you should be able to watch the publicly traded companies, at least that are in those categories that are headquartered where you are, to see what's going on. And many papers show the quarterly earnings of the major companies that are in their metro areas. Okay, and I'm going to then just skip on here, let that sit for a second. And here you can see that the total employment in the U.S. as it has risen corresponds well to occupied space. So this is just yes, it is employment that is driving demand for space as we go through things. So every quarter, I model each of the 54 largest U.S. cities and where they sit in their market cycle in the 5 major property types. As many of you probably know, the U.S. government collects data on MSAs, or metropolitan statistical areas, and they do that on any city with more than 50,000 people, and that today is 366 cities. So that data from NAICS is available to you if you're in a city with 50,000 people or more. Here you can see that in office, cities are all over the map. It's very unique to see something like this where you've got cities at a peak, cities at a bottom, and kind of moving around. And just because I'm from Denver, I've highlighted Denver here, and we'll watch it as we look at the different property types. You'll also notice that behind some of the cities, I've got numbers. And that just tells you whether or not a city has moved from the previous quarter. So at peak point 11, you see Palm Beach with a +1. That means it was at position 10 and moved up to position 11. At point 8, you see Jacksonville has a -1, which means it was at 9 and it moved backwards to 8. And you see Denver here, obviously at point 2. We had a lot of new construction that has just been coming online in Denver. For anybody there, you may have heard of the Tabor Center 2 that's going up and is being moved into now. So it can be a situation of oversupply. Many of you are going to go over and question, if you're in Texas especially, Austin, Texas, over on the right in the recession phase at point 15. Well, Austin has been the #1 employment growth market in the country for a couple of years running, pre-COVID, and the developers there knew that. And because of that, they started cranking up a lot more space. Texas is one of the easier states to build in. The restrictions are much less. So they had been overbuilding the market for a few years. And now that the demand has slowed down post-COVID, it's driven them from the hyper supply phase into the recession phase. So again, each one of these is modeled based on what I see for demand and supply, and then the occupancy rate either moving up or down in the market. Next, we look at industrial, and you see that almost every city in the country is at a peak. And the only reason that we have some cities at either point 10 or point 12 is mainly from some new supply coming on that made their occupancy level drop off of its peak level. And of course, Denver, we're watching here, is at its top. Fun to look at rent growth in industrial, #1 performing property type last year. And here I've got the top 10 markets, including, and a lot of them are port markets in northern New Jersey, Inland Empire, Miami, Philadelphia, Fort Lauderdale, and believe it or not, Orlando's sort of become a interior port market. And then the bottom 10 still all running at rates that were above the rate of inflation. So rent growth in industrial has averaged over 11% across the country in 2021, which is pretty amazing. Apartments, again, majority of markets at their peak level. And the markets that are over the top are, again, completions of new apartment buildings coming online, in addition to a few markets where people may have been moving out. And New York used to be in that hypersupply phase, but things have been coming back for New York. Retail, and probably somewhat of a big surprise to many of you, is at peak occupancy in every single city in the country. And this isn't because of fantastic new demand. As you all know, retail's been hit by online shopping, as I call it, the Amazon effect. But we have had slow new supply, and we've also had a lot of conversions of retail into apartments, office, and close-in industrial, hence restricting the supply of retail. Today, of all the new retail under construction, 80% of it is pre-leased. And during COVID, I used to say that there's two types of retailers, the COVID haves and the COVID have-nots. The COVID haves were deemed essential and were allowed to stay open. Their sales boomed. And anytime a retailer's sales boom, what do? We must be doing something right. Let's open more stores. And that's exactly what has happened in retail. Hotels, again, a kind of a COVID have and a COVID have-not situation. You can see Denver here already in the in the expansion phase, really kind of jumping back now that conference travel has picked back up. COVID if you were a drive-to resort or hotel, you had strong demand during COVID. Business travel basically shut down completely. Conference travel shut down completely. COVID restrictions lifted. Resort and leisure travel has boomed, as you all well know. Business travel is still in the process of coming back. Conference travel has picked up substantially. I'll be heading to the NIOP conference on Sunday in Chicago. When COVID restrictions were lifted, I'm a NIOP distinguished fellow, academic fellow, and so I present at NIOP conferences. And they had over 1,000 people at their first conference in Miami a year ago. So that demand, conference travel has come back, but since many of you aren't back in your office, coming to see you in an office doesn't work. So that business travel is kind of the one question mark that we have going forward from that standpoint. Okay, so that's kind of a snapshot of where we are. What I'd like to do now is talk about where are we going? What does it look like in the future? And again, my real job here, I think, is to help make you see and follow the big macro trends that are going to affect what's going on in the real estate industry. So here I go back, and in my 40+ year career in real estate, watching what's happened is I think a key to really understanding what's going on. In the 1970s, the first half of that decade, demand for office was growing at an average of about 2% there, but supply was growing at 5%. We were putting up a lot of new space. In the second half, we had a recession in '74, which is when I graduated from college, and demand turned around and picked up. We went through the information age and started adding a lot of people into office space, and demand was higher than supply. So by 1979, with demand being higher than supply, we reached a peak occupancy level national average of 95%. That put us at peak point 11, and we were cost justified with building new buildings. Well, in the 1980s, we actually averaged new supply at a rate of 7.7% a year each year during that decade. Some years hit almost 10%. Doing the math on that, we had we doubled the amount of office space in one decade, and 80% of that new construction was in suburban office space. We literally created the suburban office market, so that's pretty incredible. But actually, the most incredible thing on this graph is the demand growth. Demand grew at an average rate of 3.8%. And you ask, why is that incredible? And the answer is population was growing at 1%. Employment growth was growing at 1.6% because baby boomers like me were getting their first jobs. But demand for office was growing at 3.8%. So the macro reason behind that was the United States went through a transition of its major economic base industry. Back in 1960, 25% of all US employment was in manufacturing. Today, it is 7%. Back in 1960, only 8% of all US employment was in office using jobs. Today, it is 30%. So we transitioned from a manufacturing-based country to an information and technology country over the last 40 years. And who knows where it will go to from here. But we basically oversupplied the market and dropped occupancies to an incredibly low level by 1990. Recession in 1990, 91. And you can see, though, in that decade, the bank got smart and stopped lending to new office construction. So we severely restricted construction to basically below 1% on average for the entire decade. Almost nothing in 92, 3, and less than 0.5%, whereas demand was growing at a nice rate, averaging, around 1.5 to 2%. And finally, with more data and information, we started to get it right and matched up demand and supply very nicely in 1998 and 1999, which created, if you will, an equilibrium in the marketplace. So moving on to 2000, you can see that we oversupplied in 2000. 2001, first time ever, negative demand for office space, basically as the technology bubble burst. It came back and came back strongly, peaking in 2005, slowing back down, again going negative in 2009 with the Great Recession, and then recovering very quickly in 2010. Now you can very clearly see the lead and lag of demand and supply. As demand starts to slow down, it takes supply a few years to slow down that trend, and when demand picks that back up, it's about a 3-year lag there, because it takes a while to build new office space. Downtown space today is probably a 5 to 6 year minimum time from let's go build this to getting all approvals, permits, getting it done, and getting it in place. And the last decade, 2010 and forward, you can see with good data, we have done a decent job of keeping supply in check against demand till 2019. And so an upcycle in occupancy during that decade. And what's happening now, obviously 2021, again, a negative with COVID, followed by a moderate increase going forward, and a lot of new completions here in 2022 that in essence oversupply a number of different cities, and then we see it dropping off. And again, the scale on each of these has been different. See that this is all of it's under 1%. If you remember back in 1980, it was 0 to 10%. So got a really moderate amount of supply and demand growth going forward here. So historically, we've had demand growth running about 2%, the same as inflation, the same as interest rates, and the same as employment growth. And you can see that the supply growth has bounced around up and down above that. But going forward with this new lower forecast of a kind of a 1% demand growth in the overall economy, it appears that we're going to moderate that supply down closer to 1%. The one place where we're running higher is apartments, and I'll talk more about that when we hit that property type here going forward. So as I look at the historic occupancy cycle, the blue line, you can see that high number back in the early 80s, bottoming out in the second half of the 80s all the way up till 1991, a nice peak in 2007-8, a bottom with the tech bubble bursting in office in 2003, a moderate lower equilibrium peak in 2006, another bottom, not quite as bad as back in the 90s in 2009-10, and then medium equilibrium level here in 2018-19, but the expectation of it dropping off here in 2022-2023 as we try to sort through what's going to happen with office. I believe office is the biggest jump ball in the real estate industry today. I think we're 2 to 3 years to trying to figure out how many people are going to come back into the office, how much space per person we need. Historically, that average has been around 200 square feet per person. With technology and moving from cubicles to benching where you put people next to each other because they didn't need file cabinets or anything else, we drove that down to a US average low of 150 square feet per people. Some places were squeezing them down to 120 square feet per person. But office space is cheap compared to employees, and retaining employees much more important for most companies. So with that in mind, having more space and more attractive places for them to come to has been a driving force, and that number has risen back to about 180 square feet now. What happens with COVID, I'm unsure. So like I say, it's impossible to forecast. I'd be guessing just like everybody else. I've heard anything from a 20 to a 40% reduction in space demand based on post-COVID concepts. Okay. So again, the market's all over the map, and you can pick your city and tell a story. My story on Denver is we, other than two major buildings coming up downtown, no new construction really going on except for pre-leased, and so Denver's in the recovery phase. Are people moving out of New York permanently? Are they coming back? San Francisco, highest cost market in the country, currently at its lowest occupancy level in its cycle, as is LA, New York, and everything else. So hard, tough market to lease in, to do transactions in, or anything else. With industrial, you can see the nice long equilibrium in the early 1990s. And also notice that this scale is only 89 to 96%. So the low that we saw in 2009 and 10 was kind of the precursor to internet sales and the Amazon effect really boosting the demand for industrial, which peaked in 2018, and only because of COVID did it back off, and I believe that's coming back. You've all heard the news about Amazon letting go of some of its leases and backing out of some of the properties that it's had, putting them up on the market for sublease. But that's literally because the business managers at Amazon's were looking at what was happening. And for the 5 years pre-COVID, internet sales went from 8 to 9 to 10 to 11 to 12% of total retail sales. COVID hits and it jumps to 18%. Amazon decides that that is the new normal and it's going to continue. So they start leasing up based on that new demand number. Today, internet sales have dropped to 12.5%. So we're back on the old trajectory. And Amazon said, oops, I guess we did too much. We need to back off. The good news is that every retailer to be successful in the future needs to have an internet presence. And they were getting outbid in the marketplace by Amazon on a lot of stuff, and they all need it. So I believe that the demand is still there, and we're going to see occupancies rising over the next 4 to 5 years there. Last year, as you probably all know, we had a 12% increase in industrial rents. And while that's a huge peak, I think we're going to see that start to moderate here. We can't sustain those kinds of numbers going forward. But, and of course, what everybody's looking for is close-in warehouse. And the problem with that is that neighborhoods don't like it, and all the restrictions and everything else. Building close-in industrial is going to be like building new office. It's going to be that tough to get the permits in place and all the approvals needed to make it happen. So once again, pretty much every market at its peak occupancy, a few either over the top or just close to the top based on some new openings they have and or some Amazon leases that were put up that for release or for sublease, which decrease the marketplace's occupancies. I believe that all those will come back to peak here sometime, in a year and a half. And if we look at 2021 annual absorption, very similar numbers that we saw in rent growth, 13 million square feet in Dallas. And again, these are all major national warehouse markets where they're supplying other markets around the country. whereas the ones where the absorptions are low typically are either local markets or markets where there's a supply restriction. For instance, Orange County, it's extremely difficult to build anything new. So, and everything being built there is already pre-leased. That's one of the reasons for their low numbers. If we next move to apartments, and oh, by the way, in each of these cases, you see that occupancy and rent growth are highly correlated, and the correlations are somewhere in the 70 to 80% range. So as occupancies rise, rent growth rises, and as occupancies decline, rent growth declines. And I'm sorry I didn't bring that up earlier. You can see some little peaks in apartments kind of being held back in the 93.5% range here over the past 6 or 7 years. With COVID, huge jump in occupancy, and it looks like that will stay in place and ratchet down. We're only talking about, kind of 0.5% drops here over the next couple of years. One of the two major reasons for that, number one, first-time apartment renters come in after school, and that's either after high school at 18 or after college at 22. And the average age of a first-time homebuyer in the United States is 33 years old, and that's when they move out. But with higher home prices and home prices really jumping post-COVID and during COVID, a lot of them got priced out of the marketplace, hence they didn't leave apartment rentals. And even though we put a lot of single family homes into the rental market, it still hasn't caught up with the demand. As a matter of fact, today, depending upon which statistic you look at, the US is short of living space by somewhere between 4 to 6 million units, and that's either apartments or housing. Oh, and by the way, if I can, I'll take a second here and say, when I first started teaching real estate, people say, what do you do? I said, I teach real estate. They said, oh, you teach people how to sell houses? I said, no. Now I say I do commercial real estate, investment, management, and construction. We need to separate home ownership from income producing real estate in our friends and families and consumers' eyes. Home ownership is a use asset just like a car. It's expensive, you finance it, you got to maintain it, you use it, you live in it, and you feed it with gas and electricity just like your car. And if you sell it, you got to replace it with something else that's probably going to cost even more. So income producing real estate, which includes apartments, I didn't use the term multifamily because people go, oh, you mean like condos and townhomes? No, those are part of the home ownership market. And yes, they can be moved into the income market as well and compete there too. But we're only talking about income producing real estate here because houses don't have occupancy rates and don't have rental rates. So I can't model that the way I do this. So again, we look at all the markets, majority being at their peak occupancy. Again, ones that are over the top are only because of a number of new projects coming online that have created that problem. Last year, you would see New York and other places over there because of people moving out of the city, New York and San Francisco especially, but they're now back at peak occupancy as well. And again, retail, highest ever occupancy since I've had data available. Because as I talked about before, the restricted supply and demand is back. Retail continues to change and go through different things, but we've converted malls into a lot of different things as well. Fun story, my good friend Rick Pizer, who heads the real estate program at Harvard, his son works for a developer in Canada. They took one of their malls in Toronto where Sears moved out, and they leased that space to a Porsche dealer. Totally different use than we've ever seen before. Why? Because now the wealthy people can come in to get their car worked on and go walk around the mall instead of the dealer having to give them a ride home. So experience retail is up in many cases as well. So wipe out the Sears and put in restaurants, theater, escape room, other things for people to go to. The one key difference here is you can see that rental growth has been very low because the new users typically aren't paying the same kind of rents that the national retail chains used to pay. The other thing that I've just read some about is that many smaller retailers today, local retailers, are getting outbid on space by the national retailers who are using a lot of that store space for last mile delivery. They're bringing the stuff into the back room and they're making the back room larger to store more stuff, and making the front, instead of having a lot of product out there, they just have a sample of each thing and they'll go in the back and bring it out for you. So, retail continues to evolve. And today, of the new construction in retail going up, supposedly 85% of that is pre-leased. Once again, every market in the country, I believe, will be at its peak occupancy here a year from now. And finally, hotels, very seasonal. You can see the low season numbers and the high season numbers. I put lines there. And COVID shut it down. It bounced back very quickly, but to lower levels. And that's because of the COVID have-not of business hotels. I've heard anywhere from 10 to 30 New York City hotels will never reopen because of COVID. And a lot of them are being converted into apartments now. And just a smoother annual line so you can kind of see where things are. And by the way, for hotels to be profitable, the average occupancy rate historically had been 65%. But with technology and all the other little charges that they hit you with these days, that has dropped to 62%. So you can see that we have already surpassed that 62% occupancy level, and we're back into profitable territory for hotel operators. And again, all in the recovery and expansion phase. Pick your market as to what's happening in hotel. I know that when COVID hit, there were about 20 new hotel opportunity funds opened up to supposedly, pick up on deals. Almost no one got any deals. As a matter of fact, the founder of Family Office Real Estate Institute, DJ Van Kiernan, he works with the Marriott family. They started their own fund with some other wealthy families and weren't able to find any deals to buy. Mainly because the federal government backstopped everything and handed them money to pay their mortgages and keep their properties at least afloat or above water. And today, their biggest problem is finding help. A lot of people that left just aren't coming back to do the menial jobs that you would see in hotels. But now that the federal government assistance is gone, there may be some hotel opportunities out there. All right, so the first half of the presentation was about the financial cycle, the physical cycle. Financial cycle, much easier and quicker to talk about. It is capital flows that affect prices. If the economy is doing well and consumers are going to take more risk, they're going to put more money in the stock market and it's going to go up. When they're worried, they pull their money out, capital comes out, prices drop. Same thing with the bond market. When things are risky, people put more money into bonds, driving up their prices and decreasing their yields. So for real estate, the same thing. Real estate is about 22% of the investable universe in the United States today, bonds being 47%, stocks 31%. And so it should be part of everybody's investment portfolio. When we look at bonds, you can see here that, and this is a good one to talk to people if you're trying to convince them to invest in real estate. The average yield on the 10-year Treasury in my lifetime has been 5.7%. But the total return has been 8.7 since 1981, when interest rates peaked at 15%. So the 10-year Treasury hit 15% in 81 and dropped to its low point, obviously, in 20 with the COVID recession in May at 0.6%. So today we can't expect, we should be expecting the left-hand side of this chart that shows the average total return of 1.9%, because as interest rates go up from 2 to 5.7, the total return was only 1.9, and from that low in 53 to the peak in 81 of 15%, the total return was 3.9. So buying a bond means that you potentially are going to lose principal if you've got to liquidate that bond ahead of its maturity date. And with the low interest rates we have today, you're possibly buying a bond with a yield that's lower than the rate of inflation. Hence, you got a negative real return. So you probably all heard of Real Capital Analytics, recently purchased by Moody's. They track every real estate investment over $2.5 million in the United States in commercial real estate. And here on a quarterly basis, you can see 20 billion in capital transactions in the first quarter of 01, peaking at 160 billion in 07, bottoming to 15 billion in 09, going above that 160 peak a few times starting in 2016. You see the drop during the beginning of COVID in 2020 back down to 50 billion, and been moderating a little bit since that time. But then the CPPI, or the Commercial Property Price Index, you all know about the Case-Shiller Home Price Index you see in the papers, but this CPPI has now been produced for the last decade or so. We can take and break that down by property type. And what you see here is from the peak number in 2007 of around an index of 100. Today we're 60% higher than we were back then. Apartments 240 higher, or 140% higher. Retail 14% higher. Industrial 48% higher. CBD office 12 and suburban office 22%. That jump came from a lot of companies moving out to the suburbs to get further apart during COVID. Whether that lasts will be a good question. Here's some of the more recent numbers, and you can see that from pre-COVID, malls are down 8%, offices down 6%, everything else is up, with mobile home parks at 33%, self-storage mini warehouse at 65%. So, you know, COVID's effect, kind of interesting. But as I'm sure you all know, we express real estate prices most easily with cap rates, or the cash on cash return. Back in 01, that was 9%, coming down into the 6.5% range in 07, bouncing back up when prices dropped in the Great Recession in 09, 010, and slowly working their way back down to 6 to 6.5% today. And so people go, but that means real estate's expensive. Why would I buy it? And the answer is very simple. We have been in a lower interest rate environment, and you've got to make an investment decision today. You can't go back in a time machine and buy previously. So let's look at the yield of real estate over the rate of the 10-year Treasury. Now, how much spread above the risk-free rate of the 10-year Treasury do I get? And the answer has been in 01 about 4%, in 07 about 2%, and until the last 2 months, and I haven't updated this chart yet, you know, we're back to like a 4% range. So on a relative basis, real estate is a good relative buy to the stock market at 1.5%. Now with the stock market down, probably a 2% dividend yield, and the 10-year Treasury risk-free rate in the 3.5% range. So I don't believe, and there have been a lot of studies done looking at cap rates and interest rates, and the answer is that the correlation between those two has actually been low in history. As interest rates move up, cap rates are somewhat sticky and they don't move as fast. Although in the last couple of weeks, I've now seen more information talking about the fact that cap rates are probably going to move up about a half point here by the end of the year. And that's because interest rates are being risen so fast. One of the reasons I think Barry Sternlicht is cautioning that the Federal Reserve is probably really going to hurt us bad. But the main reason that I think we're going to have real estate cap rates be somewhat sticky is the fact that the world is awash in a lot of cash, not just the consumer money, but businesses are sitting on cash as well. And international investors are also sitting on a lot of cash. So Real Capital Analytics and Moody's started collecting data from around the world. And in 2021, you can see that global capital flows are moving differently. And by the way, in my now 40 plus years in this business, when I started in the 70s, commercial real estate was local buyer, local seller, local bank doing the financing. 1980s, the institutions got in, national buyers, national sellers, and national financing available. In the 1990s, we got access, real access for the first time to the public capital markets, the stock market with REITs for equity, and the bond markets through CMBS or commercial mortgage-backed securities. But since 2000, real estate's gone global. And if you had a gateway city like New York, Boston, San Francisco, where you put a property up for sale, 20 bidders, half of them would be international buyers. So this looks at that capital moving around the world. And you can see in 2021, the United States invested $11.8 billion into Germany, a 27% increase over 2020. Number 4, Germany and the United States was $5.6 billion. That was down 1% from the previous year. So here's my fun little story. Pre-COVID, top office building in New York, down in Manhattan, Midtown, sold for a 4 cap rate. In London, England, Class A office building cap rate 2%. In both Hong Kong and Tokyo, office buildings were trading at 1% cap rates. So to a European investor, we look like a 50% off deal. And to a Asian investor, we look like a 75% off deal. So that capital keeps flowing and that helps keep prices up. The other thing obviously is if I get an income raise and the cap rate goes up by the same percent, the price of the building doesn't actually change. So my conclusions, real estate cycles and economic cycles can be long or short. Who knows what's next? Demand and supply drive your local market. You should be monitoring those closely. Supply is going to be restricted for a while here, I think, especially with cost of labor and materials going up. And we're currently in a growth phase. The question is, how long does that last? And the financial cycle, capital flows drive prices. We got a volatile stock market making people nervous. We've got rising interest rates. In my opinion, number 1 property type, industrial, number 2, apartment, number 3, retail, number 4, hotel, and the bottom of the pack is office. Watch the COVID haves and have-nots in case something else comes along, right? And all this cash is just helping to prop prices. We also are not going to have as bad a problem in real estate because of the conservative debt pricing that came about from our last cycle. With the Great Recession, banks now typically don't lend more than 60% versus the previous 75 to 80%. So there's a lot more equity cushion before someone gets foreclosed on. And you know, the residential home ownership market versus the commercial income market are quite different, and make sure you distinguish those between people. So with that, I am going to open it up for questions.
Thanks, Glenn. A lot to digest. I think that it's been a fantastic analysis, and understanding the underpinnings and the fundamentals are critical, and you've laid them out so well, and appreciate you pointing the audience to where they can find that information as it applies to their market as well, so they can begin to do their own analysis. We will be, if you're interested, making available the quarterly report that Glenn has published, as well as circulating the recording and his presentation deck, as many of you have asked for during the session. I've answered many of the questions through the chat along the way. We are running long, so let's just take 1 or 2 minutes. If there are any questions from the audience, we can try to address. Otherwise, we will wrap it up. I would say that I think it's been interesting to note that since the Great Recession, the memory has been longer than typical, in that the credit underwriting and the level of debt has not gotten overly loose as it did going into the last cycle. So there is so much equity in the market currently that the prognosis is not as severe, even though there is a spike in interest rates as it was last time, for people to be able to work their way through the cycle. Although coming up for refinancing in the short term, that there will be some pressure on clients to begin to look at the financing.
And Jeff, I'll add to that too, that, you know, in this past cycle, the one thing we've had is, with a lot more hedge funds and other things out there looking for investments, where the banks weren't lending as much, you saw a lot of hedge funds doing, you know, mezz debt, bridge loans, all those kinds of things. So they're the ones that were providing some of that additional capital that equity didn't have. And actually, they're probably at the most risk at this point.
I think you're right, and I think that what we've seen so far is a lot of those funds coming in, buying the notes. So before the banks deal with the challenges and pressure of recycling in the market, those better funded groups are coming in to take product out of the banks, so the banks aren't dealt with the restrictions that they have and the covenants that they have that they need to force the hand. So there's going to be a play there with the loan sale market and the restructuring opportunities. So that deals with actually one of the first questions that came in: how long can the market sustain these high rates before we see relief? Are you seeing this cycle of peak interest rates? And I think you did touch on it. It's maybe a year before that we start to see some downward pressure on rates, or what would be your thought on the cycle of interest rate increases until you get the turn?
Yeah, well, if you know, we need probably a quarter or two of lower inflation, which again I think is I'm not sure that interest rates are going to slow it as fast as they might have in the past. So yeah, I think we're, you know, mid next year before the Fed finally stops hitting the brake. And historically, they've typically hit it too long anyway and caused a recession. But again, the question is, we were at 11 million job postings, and that's dropped to like 10, I guess. But that's still a ton, and we still have positive job growth every single month. So it would be very unique to see continued negative GDP with positive growth. And so, you know, the Fed doesn't have a model to look at, you know, something unique like that. And that's where I think, you know, they ought to slow down.
Yeah, and I think that one of the things with that job growth and with the reopening in China and the working out of many of the supply chain issues, that's part of the story that we didn't talk about, but seems to be behind the scenes as part of this, the inflation pressure. It's not as much over demand as restricted supply, and through COVID for everything to be switched back on and coming back to full capacity has taken some time. And as that supply comes back and begins to stabilize in the face of reduced demand, it may come back into balance sooner than I think some have thought. So we're optimistic. I am anyway, about the supply chain being sorted and the balance towards equilibrium coming sooner.
Right. I'm hopeful as well.
Yep. So I think we need to wrap up. Again, we will be sharing the information. We appreciate your time, Glenn, and your your insights, and appreciate everyone joining us today and staying a little bit longer as we've covered a lot of ground. Fantastic to get the insight, and we'll look forward to hopefully having you back next year and being in a better spot. So
Yep.
thank you
Thanks
very much.
Right.
Bye-bye.
Bye.